1.1 What is Elliott wave theory? Elliott wave theory is named after Ralph Nelson Elliott, July 28, 1871, January 15, 1948. He was an American accountant and author. Inspired by the Dow theory and by observations found throughout nature, Elliott concluded that the movement of the stock market could be predicted by observing and identifying a repetitive pattern of waves. Elliott was able to analyze markets in greater depth, identifying the specific characteristics of wave patterns and making detailed market predictions based on the patterns. Elliott based part his work on the Dow theory, which also defines price movement in terms of waves, but Elliott discovered the fractal nature of market action. Elliott first published his theory of the market patterns in the book titled The Wave Principle in 1938. 1.2 Basic principle of the 1930s Elliott wave theory. Simply put, movement in the direction of the trend is unfolding in 5 waves, called motive wave, while any correction against the trend is in 3 waves, called corrective wave. The movement in the direction of the trend is labeled as 1, 2, 3, 4, and 5. The 3-wave correction is labeled as A, B, and C. These patterns can be seen in long-term as well as short-term charts. Ideally, smaller patterns can be identified within bigger patterns. In this sense, Elliott waves are like a piece of broccoli, where the smaller piece, if broken off from the bigger piece, does, in fact, look like the big piece. This information, about smaller patterns fitting into bigger patterns, coupled with the Fibonacci relationships between the waves, offers the trader a level of anticipation and/or prediction when searching for and identifying trading opportunities with solid reward/risk ratios. 1.3 The 5 waves pattern, motive and corrective. In Elliott's model, market prices alternate between an impulsive, or motive phase, and a corrective phase on all time scales of trend. Impulses are always subdivided into a set of 5 lower degree waves, alternating again between motive and corrective character, so that waves 1, 3, and 5 are impulses, and waves 2 and 4 are smaller retraces of waves 1 and 3. In Figure 1, wave 1, 3 and 5 are motive waves and they are subdivided into 5 smaller degree impulses labeled as I, 2, 3, 4, and V. Wave 2 and 4 are corrective waves and they are subdivided into 3 smaller degree waves labeled as A, B, and C. The 5 waves move in wave 1, 2, 3, 4, and 5 make up a larger degree motive wave, 1. Corrective waves subdivide into 3 smaller degree waves, denoted as ABC. Corrective waves start with a 5-wave counter-trend impulse, wave A, a retrace, wave B, and another impulse, wave C. The 3 waves A, B, and C make up a larger degree corrective wave, 2. In a bear market the dominant trend is downward, so the pattern is reversed 5 waves down and 3 up. Elliott wave degree is an Elliott wave language to identify cycles so that analysts can identify position of a wave within overall progress of the market. Elliott acknowledged 9 degrees of waves from the grand supercycle degree, which is usually found in weekly and monthly time frame, to subminuet degree, which is found in the hourly time frame. The scheme above is used in all of EWF's charts. 1.5 The rise of algorithmic, computer-based trading. The development of computer technology and internet is perhaps the most important progress that shape and characterize the 21st century. The proliferation of computer-based and algorithmic trading breed a new category of traders who trade purely based on technicals, probabilities, and statistics without the human emotional aspect. In addition, these machines trade ultra-fast in seconds or even milliseconds, buying and selling based on proprietary algos. No doubt the trading environment that we face today is completely different than the one in the 1930s when Elliott first developed his wave principle. Legitimate questions arise whether Elliott wave principle can be applied in today's new trading environment. After all, if it's considered to be common sense to expect today's cars to be different than the one in the 1930s, why should we assume that a trading technique from 1930 can be applied to today's trading environment? 1.6 The new Elliott wave principle. What is changing in today's market? The biggest change in today's market compared to the one in 1930s is in the definition of a trend and countertrend move. We have 4 major classes of market: stock market, forex, commodities, and bonds. The Elliott wave theory was originally derived from the observation of the stock market.